From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 5th. It's Jobs Day Friday, and boy, we had one of the most surprising jobs days. We knew that coming in the context of this week with everything that's going on with COVID and the reopening and the economy, that this jobs day was going to be interesting. And boy, was it ever! The numbers were couldn't have been as far off as from what people were expecting going into this. It's also happened at a time of real stress in the country as the country is dealing with the fallout of the issue of the murder of George Floyd, which really, I think, led to a tipping point in this country in its discussion of race, of inequity and injustice towards Black Americans, and just one of the most important and emotional issues that we are bringing attention to in this country, with protests on the street, with discussions on TV about it, and we're certainly not immune to that. The business community isn't immune to that. We saw this morning, Doug McMillon, the chairman of the Business Roundtable, a group of the largest American companies, came out talking about the big company commitment to it. I think we all hope that is that's real and durable. And one of the things that struck me is that the point of introspection on all of this. When we say we should do something, we're usually talking about a royal we of what society should do on this. And I think what companies are saying and what we at Hamilton Place Strategies are saying about ourselves, looking at ourselves, is it is a specific we. More than that, it's an I. I need to address these issues. I need to think about my contribution or lack of contribution to solutions on these issues. And so we're looking to see what the business community does in addressing race in America, specifically with the Black community, and that's going to be an important part of our dialogue in this country for some time, and I think that's good. We're going to come back to it here on the Macrocast in the weeks and months ahead, and spend time talking about the economic situation facing the Black community in America.
Tony, that's very well said. And the lesson I think we learned from the 60s is that protests are important, but protests without policy change kind of ends. So this election is going to be one of the most important elections we've had in the history of our nation, because your elected officials are the ones that are going to implement those policy changes. So we'll see, what happens in the next 6 months.
Yeah, and look, and I think for firms, and I think for successful economies, we go around talking about how diversity of experience, of knowledge, of perspective is a strength, right? It's the kind of thing that actually should strengthen and create more durable and successful companies and firms. I've always said, giving a talk this was on a gender issue, and talking about if I have to go hire the men who are in the wrong side of the distribution curve, because I have a bias towards hiring men, and I'm not hiring the women who are on the strong end of the distribution curve, I'm weakening myself. We're weakening the business. We're weakening the economy, because we're not getting the greatest value out of the most productive people. So in addition to being immoral, it's also dumb, right? It's bad. It's bad for the success of organizations and businesses to not have open, equal opportunity. In addition, and specifically, also the protection of the state of its people, and protection of their safety and their rights. Those are baseline issues for for us, and it's what we need to devote ourselves to. Each one of us in our, in our homes, in our personal perspective and outlook, in our businesses, in our society, in our politics, in all of those levels, we need to be important drivers of change to address this very specific issue. And trying isn't, no one's going to get credit for trying anymore. It's got to be about doing and accomplishment and success. So like I said, we're going to come back to this. We're going to spend time on these issues in coming Macrocast, and it's, our space is looking at the economy and looking at how economic actors are working or not working, and that's the way we'll address it on the Macrocast. But I think there's a lot of rich data analysis out there that we can bring to it, and we're definitely going to devote some segments to it going forward. But for today, we have to turn to this jobs report, which is a real stunner. And so we saw President Trump out this morning already, cheering on the jobs report. It's obviously confounding. I tweeted out that we know nothing. Not just wrong in terms of missing the mark, but definitely wrong where jobs actually increased rather than further fell. There may be reasons for that. Fortunately, we have in addition to Brent Walsh, John Fagan from Markets Policy Partners, my partner Matt McDonald here with us, as he is every jobs day, to break down this confounding jobs report. And Matt, have you had enough time to?
I'm very happy Matt's here this week because I'm taking notes on this one.
Yeah. Well, let me start by echoing what Tony said at the outset. This is a difficult jobs number to understand or to parse through. It's very complicated, and it is coming at a time where I will speak for me personally is that I'm finding it very difficult to focus on some of this stuff. I think it's hard for lots of people. We have Black colleagues working on these numbers right now, trying to parse them out, and it's not an easy time, but we'll do our best to understand what is going on here. So what we've got, the total non-farm payroll rose by 2.5 million in May. Unemployment rate declined to 13.3. That's a decline of 1.4 percentage points. Let's talk through a little bit of where we're seeing these gains pop up. Leisure and hospitality increased by 1.2 million. That's following losses of 7.5 million in April, 743,000 in March. So that's a bounce off a pretty bad floor. Construction increased by almost 500,000 in May. That's gaining back almost half of April's decline for construction. Education, health services. This is a place where we talked previously about the conundrum of the health sector having lots of layoffs at the time where we have a pandemic, and how, when you dig in, you understand what's going on in terms of elective procedures and that sort of stuff, but it's a weird thing to see.
Yeah, I went to the dermatologist a couple of weeks ago, and I was one of the first ones, and it kind of hits you there, just how much of the healthcare system is actually elective and quote unquote. Yeah. That increased a little over 400,000. We have retail's up by 368,000. Again, that's after a loss of 2.3 million in April. So, I mean, what we're seeing on some of these sectors is, we're seeing individually within these sectors job gains that in the past for the total economy in 1 month would be viewed as really strong numbers. And yet these are just, in some of these cases, it's a fraction of what these sectors have lost in recent months as well.
Just a few other thoughts on this piece.
Actually, Matt, let me ask you a question.
Yeah.
In education, have we seen any layoffs? So, I mean, that's a state and local issue,
So,
but it's hard too because of the seasonality. Teachers, technically get laid off in the summer. But are we seeing any layoffs at the state level on that front?
It's a good question. I don't know the answer offhand. The education is lumped in, I believe, with health services.
Yeah, so it's confusing.
And
I see that one, but I don't see education on its own.
well, the other piece is that I think that government employment has declined, which is I think a lag from where they were, but I'm not positive on this stuff.
Yeah.
The
but
other
that would really be an important lobby data point in the next month or two. Yeah.
Yep. The other, a couple of other points I would make is that one, we had the state level job data come out for April a little while ago, and it's hard to, we're looking at aggregate numbers here. What we're seeing across the country is different economies. I mean, we really are. And
really important point.
And so, people, I think that oftentimes when people understand the United States, sometimes it's easy to forget what a mashup or aggregate of different locations, regions, economies, cultures the United States really is. And this is a time where it's hard to understand aggregate national data without understanding that dimension. I think that when we get the May state level unemployment and employment situation report, which typically happens in about 2 weeks, and then match that up to phased openings and different local policies, I think that'll be helpful in understanding the data and where we are on this.
It's a great point, especially with the COVID infection numbers. Looking at the national numbers is worthless.
Yeah.
You have like you have the Northeast, which those numbers are coming down dramatically. And then you actually have the South and Southeast, and those numbers are troublingly going up. So you have to, but also more importantly, the decision wasn't made at the federal level. It's made at each governor's level. So everyone has different policies. So you have to break it down.
Or even at the city and local level.
City,
I mean,
you're right. Yeah.
Here in like the DC, Maryland side of town is like Montgomery County has a different policy than Calvert County.
Yeah.
I mean, it's just, there's different stuff going on. So a couple other points to raise. So one, I also looked at revisions on this stuff. So, the 2.5 million number, I think, is a shocker to most observers. There was whispers of a 20% unemployment rate. I think people were generally expecting millions more in lost jobs. How bad do things get? That type of thing. So March was, so the March numbers, which was the early end of this, and we talked previously about the problem with the March numbers, and when stay-at-home orders were announced shortly after that, March employment was revised down by about 500,000. So the total numbers from March ended at negative 1.4 million loss. But April was only April was only, now that's the second revision of March. So I guess that should be the final, but not really the final, because BLS does whole year revisions on some of this stuff later. April was in their, first revision was revised down by only 150,000 off of a loss of 20.5 million jobs. So that's a pretty narrow margin of error.
Yeah.
Now, I don't know, I guess my takeaway on that is that if we had a revision with all the volatility in March, if we only had a revision of 500,000, and then in April with the massive size of the losses and we only had a revision of 150,000, I don't see the 2.5 million in May getting revised down to a negative number so that so that this on that magnitude of error. And let me just say for a moment on the BLS data is that they are doing their best in a very difficult circumstance. So this is kind of what we've got to go off. This is these are government professionals who take their job very seriously and doing their best in as we all are in trying circumstances. So I don't see this getting revised negative, which to my mind would indicate that there may be setbacks in the future. But my first take is that we've probably seen bottom. Now the big fat caveat on that point that BLS includes is, and this is something that was raised in the last jobs report as well, is that household survey interviewers were instructed to classify employed persons absent from work due to coronavirus-related business closures as unemployed on temporary layoff. But BLS says that it's not clear to them that all such workers were so classified. So again, they are doing their best, but there's a lot of volatility in the data, and that misclassification could have kind of material impact on what we're seeing.
Yeah.
So
it's also important to keep all this in perspective, where 2 million doesn't really mean anything. Basically, the story of this is over 20 million people went out of work because we had to shut the economy down. Last month, 1 in 8 of those people returned to work, which is a great development. But, to put into perspective, draw an 8-inch line straight down and then draw a 1-inch little check. That's where we're at. We have a long way to go, but knock on wood, it looks like the healing has begun. But at this pace, it would take, over a year to get us back to where we were.
John, what are you saying in this?
Well, this is kind of an aside, and obviously any of the dynamics that I'm talking about in the labor market wouldn't rise to the kind of magnitude that we saw in the surprise of this report. But there were certainly some questions over preceding weeks about the risk that companies that received loans under the payroll protection program, which requires the money to be spent on maintaining a headcount, and you have to have the headcount flat at the expiration of the program, which was an 8-week window, and that you would then once you checked the box on that, the loan would be forgiven, and then then what you did with your headcount was up to you as a recipient of these loans, and so there was some concern in the policy community that there would be some artificial employment going into the end of at the expiry of these PPP program windows, and then afterward there may be some kind of mini cliff of expelling workers and cutting headcount after they'd already gotten their PPP loans forgiven. Now, this necessarily, again, this wouldn't be on the scale that we're seeing in this jobs report, but it was a real concern, and it was the way that the program was structured. The Senate passed a bill last night that would extend the PPP and take it from 8-week window to a 24-week window, and at the same time also loosening the restrictions on what you can spend the money on. In the previous version, it was 75% on payroll, but there was some feedback from companies saying that this was relatively onerous, and so the revision takes it down to 60%. And this is, now also the payback. The repayment window is now 5 years, as long as 5 years instead of 2 years. Initially, this is going to the president's desk. This is meant to try to ease off some of the restrictions that had been binding on these companies, and it had actually left about 130 billion in the PPP coffers that hadn't been drawn down. And I think the expectation here is that this is going to get signed by the president, and if these revisions are the solution, that's another wind at the back of the labor market here, and perhaps could lead to another top up of the PPP program if this last 130 billion gets drawn down as a consequence of these loosened restrictions.
Yeah, there are definitely there are a lot of indicators out there, right? That of things moving back. Who knows whether the program is having that impact or not? It's hard to say. And there's still a lot of I think there's a lot to look into in a lot of these numbers to see exactly what is going on. And but there are indicators like I saw some indication that driving the mobility is at something like January levels already. Now, mobility is down in January relative for the rest of the year, so it's not like a peak mobility driving period. But still, to say that we are back to pre-COVID levels in any way on mobility is saying something. There is activity out there, and we said last week, look, yeah, but these are all snapshots of the moment. Everything that we're looking at is a snapshot of the moment. It's hard to say what this means for the future because we still have epidemiologists out there saying second wave. We're seeing in a number of states like Arizona having a spike and Texas spiking with increases in cases. There's a lot of uncertainty still out there at all. The markets, though, don't seem to have any uncertainty at all about the future, and they're obviously cheered by this number. As I'm looking at futures right now, about 750 points in the Dow, about 70 points in the S&P. It should be a roaring day in equity markets. Closing out and going into the weekend. But the president says the markets are right. Are the markets right?
Yeah, we've seen the Treasury market has been the most dour of the markets here. The 10-year Treasury yield, which is correlated with growth expectations and inflation expectations, has been dead in the water, below 1%. Hovering around 60 to 70 basis points, exceptionally, just incredibly, historically low. It's finally the last couple of days. It was really the ADP number earlier this week that sort of woke the 10-year up. Nothing else seemed to have done it, and now the 10-year is popping northward here. Nothing particularly great in terms of the overall level at 90 basis points, but compared to where it was, that's a 20 basis point move roughly in the span of a week. That's a lot, and so there's some incremental flickers of life here in the Treasury market, which tends to be the more prescient market in terms of economic outlook. The equity market has been, on a run, and as we've discussed in the past, the early kind of stages of the rally were led by tech and the sort of winners of the pandemic and the healthcare, the stuff that was going to be okay whether we got a second wave or not, and it had a relatively defensive character to the rally. That's switched to some extent to a relatively major extent now. The rotation has gone away from the big tech stocks and healthcare back into the growth sensitive stocks that have been lagging, banks, industrials, and so forth. So the equity market has totally made up its mind. The Treasury market seems to be changing its mind a little bit here. And obviously the commodities have been boosted. The dollar has fallen out of bed over the last 2 weeks, which tends to be a really good indicator for global growth. So all signs are pointing in a particular direction.
And John, what about Europe?
Yeah, well, Europe has had a really good run here. We talked in previous episodes about the stimulus plan that is being considered. It was put forward by the European Commission last week, which upped the number of their fiscal boost for pandemic relief to 750 billion euros, with a very historical aspect of fiscal federalism, of burden sharing. On the fiscal side, which is just a watershed potentially for the euro area. We saw the European Central Bank come in and surprise the upside. So European stocks and regional bonds and the euro have been outperforming for the last couple of weeks. So it's the markets are giving us this all clear, bright, things are all moving in the right direction. And then when you watch the evening news, the disconnect is really stark. And markets are supposed to be leaning forward, but the question really is, Brendan's alluded to this in the past. if you've got a federal government that's, really, really hurting for money, state government's hurting for money, and all of a sudden you've got the stock market at record highs and corporate America doing pretty well. And a lot of it, you start thinking, well, if you're doing pretty well, then maybe it's time to give some back. And so thinking about if there's a Biden administration that comes in, the tax plans, he's been a little bit cool on a financial transaction tax, but it's easy to see that the stock market is kind of making the case for him here.
I mean, yeah, to move to that side of things, like I just think that the past, the past months, but in the past week, have had a material impact on what the likely outcome of the election is. I think that the probability of a Biden administration has gone up, and the probability of a Trump 2 has gone down. The other thing on a potential Biden administration is that the past week has also had a material impact on what the agenda of that administration will be. And I do not see the kind of Bernie Sanders and Elizabeth Warren's of the party in a position of authority or leadership in terms of what the first 100 days agenda looks like. In politics, you dance with the one who brung you. And I think that injustice, economic opportunity in Black communities, criminal justice reform, these are going to be front and center for a Biden administration. And to be honest, I think that there's a lot of economic upside to all of those pieces in ways that kind of, regulatory agenda oriented components. You can argue the merits on some of that stuff, but that's not necessarily recovery oriented expansionist type of policies. So I think that the ground is moving seemingly every week, but I would say in kind of the current context is that there is, from that perspective, there's a lot for the market to like. I think it's just more of a question of, on some level, it's a question of like, so is the market just ahead of themselves in terms of the economy and what it looks like? The jobs data today would say that I don't think we're not going to have a V shape in terms of the V going back up to where we were, right? I've always thought of this as like a reverse square root sign.
Yeah.
There's going to be a part of it that looks like a V. The back end will not get up to where the front end was. And the question is like, how sharp and how long does that look like?
Yeah, I think that's right. I mean, the question is always going to be, whether it's for markets and for the economy and for the political outlook, is whether you get back to levels. It's hard to say that that we can get back to the levels that we were anytime soon, while we know that there have also been, elevated bankruptcies, a number of companies that aren't going to be coming back soon. So that's going to take time. We'll have a lot to talk about over the next few months about what the implications and consequences are for both for the election and for economic policy going into next year. So lots to consume. One thing, Brendan, I don't know if we have anything on. I haven't looked at data for next week. Is there anything we should be looking forward to?
So this was kind of the big week. Next week's is a little more quiet, but we do get the CPI inflation numbers. But it's going to be a while before inflation normalizes from everything that's happened from the shutdown. So in terms of the Fed using the inflation numbers as an important input into their decision making. And then we also get the University of Michigan consumer sentiment. And then that's kind of in terms of market moving stuff. But always we get the, our weekly unemployment claims. And now when this all started, we were kind of focusing on the initial claims, but now the continuing claims is probably the more important component of that, because that indicates how many people, a decrease in that means someone went back to work. So 2 weeks ago was a little disappointing. We thought that more people went back, but the jobs numbers kind of indicate that that happened in that maybe that last week. So that's one we're going to be following closely.
Well, we'll be ready for it and keep an eye on it. As though we'll have a lot to talk about next week, I'm sure. Thanks for joining us here on the Macrocast today. Please enjoy the weekend. Please stay safe. Please take care of each other.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.